Hello, everyone. This is Ted Bauman here, editor of the Bauman Letter, of Profit Switch, and of the Bauman Daily. Before I proceed, just a reminder that Clint Lee's new options trading service, Flashpoint Fortunes, is out and about and has a tremendous track record. Only just in the past month or so that it's been in operation, many triple-digit winners. So I would encourage you to look at the link below to consider buying into it. Today I want to talk about inflation. Everyone is mortified, afraid of inflation. We've seen just in the last couple of days rising long-term yields, midterm yields on the 10-year and the 30-year. Treasury bonds, we've seen mortgage rates increase right in the middle of people trying to refinance, and we see people getting scared. Inflation is bad for stocks too, and that is what I want to talk about today. But I want to talk mainly about why the pressure for inflation is not coming from where you think it's going to come from. It's going to come from an accumulation of policy decisions that have been made in the United States and by the United States government going back to the 1940s. Now, first, a brief summary of why inflation is bad for stocks. When inflation goes up, it means that bond rates have to go up to maintain real return on bonds. So if you have an inflation rate of 2% and a bond yield rate of 2%, a real yield, the nominal yield on the bond has to be 4%. So the higher inflation goes, the higher the rate of return on federal treasury bonds has to go. That makes them more attractive relative to stocks, which means that some people pull out of the stock market and they try to make money in the bond market instead. So that reduces the amount of liquidity in the stock market, which means that stock prices come under pressure. But there's a second reason, and that is because when investors look at the future earnings of a company, which is what you're buying when you pay money to buy a stock, they discount those future earnings against the current interest rates, basically whatever the current rate is. Now, what that means is that the higher the interest rate, the less the current value of future earnings is from a company. So for example, from you get growth companies like take Zoom, for example, any company that has a very high price to earnings ratio. One of the reasons why people are willing to pay huge amounts of money for it is not just because they expect that company to make money in the future, but that money is going to be worth a lot, and it's worth a lot now even though it hasn't been earned. It's worth a lot now because interest rates are so low. Raise interest rates, that means that those future earnings of a company like Zoom are not worth as much right now because you've had to discount them. It's a formula you use. A lot of you probably understand how this works, but the critical thing is that there is a definite relationship. When interest rates go up, stock values, all things being equal, go down. And that is the second reason why people fear inflation from the stock market. But here is an argument as to why inflation is actually baked into the system. All right, let's start with the first point that Lynn makes in her article. The first thing she says is that just like in the Great Depression of the 1930s, we've seen a stagnation of industrial output over the last decade. It hasn't been as easy to see, and we don't see people in soup kitchens or standing in lines, or at least as much as we did back then anyway. But the reason for that is because the policy response is a lot more sophisticated and a lot quicker. And that is to recapitalize the banking sector to make sure that if banks are threatened by loans that are potentially going to make them insolvent, Congress stepped in with TARP and all this other stuff during the aftermath of the great financial crisis, and that helped to keep us out of a total collapse. But still, the fact remains that one of the most important drivers of ordinary employment for wage earners in the United States has been fundamentally stagnant during the whole decade right up until now. And of course, it got hit with a serious body blow as a result of COVID. And again, the point is that it's not easy to see because stock prices have been doing so well, and in many ways the economy seems to have been okay. But as we all know, at the very basic level of wage jobs, things have been bad. People lost good jobs and they've only been able to get relatively low paying ones. And that's been the case for more than a decade. Now, the critical point here is that this is partly by design. And to understand why, you have to go back to the role that the United States dollar plays in the international system. Prior to 1974, we have what's called the Bretton Woods system, where the dollar was backed by gold. And in the tail end of his presidency, Richard Nixon decided to abolish that connection. But that left the dollar floating without really any anchor. So to try to figure out a way to stabilize everything, the United States reached an agreement with Saudi Arabia under which the Saudis would only accept US dollars as payment for their oil exports. Now, this is significant because think about it. If you're a country that wants to import oil from Saudi Arabia after 1974, you have to have dollars in order to do it. Where are you going to get dollars? Well, you do that by selling goods to the United States in exchange for payments in US dollars. So effectively, what that means is that in order to keep the US dollar as the reserve currency, to make it the most demanded currency in the world, which it has become since 1974, you don't base it on gold. Instead, you make sure that it is something that you can only acquire by using dollars. The downside of that, unfortunately, though, is that that means that we have to make sure that we are constantly exporting dollars to the world. And we do that by running trade deficits. In other words, we limit our own manufacturing and we increase imports from other countries so that dollars flow out, which can then be used to buy US Treasury bills, for example. So we've had this paradoxical situation where it's in the interest of the United States government and the financial authorities and the banking system to weaken U.S. manufacturing, to weaken U.S. exports, and to make imports of foreign goods more attractive. So it's not just the nefarious Chinese, it's not tariffs, as President Trump suggested. It's really goes back to the fundamental role that the dollar plays. We have to run trade deficits in order for this system to work, and the only way we can do that is by buying more than we sell. Now, of course, the flip side of that, as I mentioned earlier, is that gives dollars to people overseas who can then use them to buy U.S. Treasury bills, which means that we're able to run deficits. So we can run deficits as a government, we can run deficits as individuals, but our ability to produce the income to pay back those deficits is declining over time. Now, this relates to the question of inflation in this way. Twice in the last century, what we've seen is a banking crisis that led to a deleveraging on the part of the financial sector where people tried to pay off their debt, get rid of it. That meant that liquidity was being drained from the economy, which slows down economic activity. In both cases, something happened that prompted the federal government to pump money into the economy. Lynn has called it MMT, which means modern monetary theory, and essentially that's what it is. It's the Fed prints money, gives it to the Treasury spends it into the economy. That in turn helps to compensate for the decline in debt, which is also linked to a decline in consumption. So essentially, the federal government is stepping in to bolster the economy in a situation where people are trying to deleverage to pay down debts. In the 1930s and 40s, that was preparation and execution of World War II. Since the great financial crisis, that has been a gradually increasing level of federal debt, first because of tax cuts, but more recently because of spending because of the pandemic. But the bottom line is that in order to pay this debt off, the United States is going to have to run some kind of inflationary pressures to be able to reduce the the real value of the debt. After World War II, the Treasury Department and the Fed reached an agreement to keep long-dated Treasury bonds at very low yields. And at the same time, the government pumped money into the economy to try to boost inflation. And that meant that the real value of those federal bonds was falling. It made it cheaper for the government to pay off. That was part of the reason why we had high inflation, or relatively higher inflation, during 50s, 60s, and early 70s than we did afterwards. After that, after the crises of the 1970s, there was a turn against that. We saw rising interest rates under Volcker during the Reagan administration to try to smash inflation. And ever since then, we've had low inflation. But the argument here is that because of this tendency, in order to try to compensate for crises, the U.S. government is going to have to try to inflate the economy, and that scares a lot of investors. Now, here is the proximate reason why that scares investors. This chart shows the relationship between QE, which is the Fed buying treasury bills out of the market and in exchange for money, which is then recycled into financial assets, and the green line, which shows federal expenditures. After the great financial crisis, QE took off like a rocket. The Fed tried to pull back. That upset the markets. So finally, the Fed kind of accepted that they were going to have to keep going at it. And with the exception of a brief period during the late 2020s, the Fed has been more or less continuing to maintain a lot of liquidity in financial markets by buying Treasury bonds. The green line shows the federal government spending. That little spike around 2009 was the Recovery Act, which was much smaller than people thought it should be. But look what happens in 2020. The most dramatic spike in the last decade or so in federal spending, and that is because of the pandemic. It's payments, people getting stimulus checks, people getting pandemic protection loans, all the other forms of unemployment that have been developed since then. All of that is going out into the economy as spendable money. Now, QE has also ramped up, but it's the spendable money that makes the inflation people worry. Now, on top of that, we have the prospect of a stimulus-oriented government, and let's talk about that now. Now, I've shown you essentially how the U.S. system, in a sense, encourages the decline of economic activity in the country, which basically keeps a lot of people out of well-paying jobs. It means that we're buying more than we sell to the world. It means that the dollar is out there, but it's out there being used mainly to buy U.S. government debt. It's not being used to buy things that Americans make, and this is by design. Now, the problem is that when you have a financial crisis, you have a banking crisis, the government has to step in and pump more liquidity into the economy in order to try to compensate for it. Under normal circumstances, most of that liquidity goes into the banking system via Federal Reserve purchases of Treasury bills, which are used to pump liquidity back into the banks, which helps to keep interest rates low. But here's the problem. Recently, the government has done something it hasn't done in a long time, and that is to pump money into the real economy. Now, we know that a lot of that money is being used for necessities, but current estimates are that there's about $1.5 trillion worth of money in banks, in deposits. I showed you the chart just now. The blue line was bank deposits. That money is there waiting to be spent. And the big fear is that when you combine that with a government that is intent on trying to stimulate the economy even further, when you have a Fed chairman, Janet Yellen, coming in, who is very focused on trying to improve wage income and so on, and is willing to tolerate higher inflation, plus all this money out there, you have three things that are basically pointing in the direction of inflation. Now, for a long time, I personally have been skeptical about whether inflation is actually likely to happen under these scenarios because, for one thing, foreign countries have been able to step in and provide all the goods we need, which has kept the price of goods down. Even if Americans have more to spend, the supply of goods is perfectly elastic. There's plenty more where they came from. But now we're in a situation where we have a history, 4 years, of trade conflict with China, with Europe especially. And in that case, we may find it more difficult to replace or to provide enough goods for people who want to buy them because of the distortions in global trade that have been created, not just by the dollar's role, which is a meta distortion, but by the distortions that our politicians have introduced into global trade through tariffs. That means that the prospect of inflation, short-term inflation, particularly in the kinds of things that normal people buy on an everyday basis, wage goods, retail stuff, staples, consumer durables, all that stuff is likely to go up in price if the economy recovers suddenly. And that is why Wall Street is so concerned. But the thing to remember is it's not just about the short term. It's about the bigger picture. As a country, we've made a deal with the devil over the last 50 years or so to keep the dollar strong so that we can benefit, but it means we have to gut our economy to do so. And that makes us weak, that makes us vulnerable. It means we require imports, and if we can't get enough of them, inflation is going to come and your stocks are going to go down. Anyway, this is Ted Bauman signing off. We'll be back next week. Next week, I promise I'm going to give a couple of active tips, companies that I've identified that I'm willing to share with you so that you can benefit. Take care.